Hello again and welcome back to my channel. My name is Patrick Allen. I'm a licensed realtor with Keller Williams Southern Arizona. And in today's video, we'll be discussing real estate. Welcome back to another market update, the latest chapter in the soap opera that is the Tucson real estate market these days. And so if you're considering possibly buying or selling a home or investment property in 2024, and you aren't sure exactly what the market is doing right now, you're not alone. We are still in one of the most confusing markets of the last 30 years. And the issue at the center of it all remains the same. What happens when an unstoppable force meets an immovable object? In our case currently, the unstoppable force of low housing supply has done an effective job of keeping prices propped up, despite the seemingly immovable object of fewer buyers willing or able to buy due to low affordability. And as our local market entered the sleepy holiday season, we had some confidence that December's market statistics would redefine the lowest levels of both supply and demand, and would therefore give us some clues as to what our market might look like as we enter the mid-2020s. So what did the market do at the end of the 2023 season, and what does it mean for 2024? We're going to dig into some data and market statistics and piece together an answer for you no matter your long-term investing. Let's dive into it. Now, since we are dealing with two primary opposing forces, let's first cherry pick from the most recent data points to support the argument that our market is down, first on the demand side. The first and somewhat obvious caveat that I have is that of traditional seasonality. Now, despite months on end of triple-digit temperatures and an absolutely surreal number of sun hours, the real estate market tends to always peak in June in terms of both home pricing and the number of sales which occur. Put simply, if there's a family on either side of a home sale, they probably prefer to close in June so they can be moved into their new home while the kids are out of school for summer break. Now, due to this very predictable dynamic, we expected less buyer demand between Halloween and Super Bowl Sunday. And with the unpalatably high interest rates that we experienced throughout most of 2023, this chart provided by Fannie Mae tells us that the last 18 months has seen arguably the fewest number of mortgage applications being submitted relative to the number of people locally who theoretically could qualify for a mortgage than we have ever seen on both a local and national scale. The most recent demand trough to help put our current situation into context seems to be way back in the early 1990s, where I imagine many of you watching this video were not exactly mixing it up in the tumultuous housing market on the other end of the savings and loan crisis of the 1980s. Either way, we can see the same dynamic playing itself out in the usual metrics that we track. December 2023 saw the fewest number of closed sales in any month since around 2015. And with closed sales being a lagging indicator, which better describes the demand of 4 to 6 weeks prior to the numbers actually being reported, when we look at the number of pending transactions in December, we again see that it has been 10 years since we saw that number drop below 700, even in December. A remarkable figure which gives our current positioning some sort of a historical perspective. And although affordability has been bouncing around the lowest levels that we have seen since before the Great Financial Crisis, interestingly, it moved up a bit month over month from November into December. And although we'll see later that home prices rose from the prior month, those prices were in fact slightly more affordable due to a largely unnoticed drop in interest rates between early November and the end of December. So this short-term bump up is the most substantial upward move that we have seen on this slide since 2021. Would only that it would actually continue to move that way as we enter into the new year. And a bit more about that idea at the end of the video. So now looking at days on market, this figure rose slightly in the fourth quarter to indicate that homes took longer on average to sell in December than they did in August or September. No big surprise when you consider normal seasonality, and even in the mid-40s, our market has in fact spent a good majority of the last 10 years at or above that number. However, we can still expect to see that figure trending closer to 30 days on market next summer season, as a drop in DOM entering the summer months has become quite predictable over the last 5 years here in Tucson. And so if all of that paints the picture of the demand side, if anything, our supply side has dropped even more to keep pressure on pricing even throughout the year's wild affordability ride. Now, because seasonality also affects new listings coming onto the market, we can also see that we experienced the lowest number of new listings last month than we have pretty much ever seen since we started tracking these numbers back in the 1990s. This comes back to that rate lock-in effect, where homeowners and real estate investors finding themselves not wanting to list a home for sale, knowing that they will have to turn right around and buy a new property in the same market, effectively trading in their sub 4% interest rate for a current market rate of 7% or higher. Now, there's something of a silver lining to this statistic in that we almost always see a major rebound in the number of new listings coming to the market in January. But due to persistently limited new inventory coming onto the market over the last year or so, the statistics for supply have been pretty flat for some time now. Looking at the number of homes for sale, we can see two things of note. The first is that for basically the entire year of 2023, we have been bouncing around 2,000 homes for sale at any given time, plus or minus about 10%. Now that number of roughly 2,100 homes for sale at the end of the year is also roughly what we had available 4 years ago, when no one had heard of COVID-19 and our market was about as normal as it has been since that time. So inventory is flat, as is month supply of inventory, which looks at the relationship between the number of properties available for sale and the rate at which they actually go under contract with a new buyer. This number similarly has been hovering around the 2-month range, never crossing into more than 3 months of inventory, and rarely spending any amount of time below 2 months. This number is basically exactly where it was this time last year, as we saw pending sales drop off in Q4 of 2022, just like we saw last month. And now when we look at home pricing, we can see the lack of any substantial increase in inventory meant that values remain pretty flat, though slightly increasing on a year-over-year basis. At a median sales price of $385,000, we are just about $10,000 in appreciation on a year-over-year basis, or about 3% up from December of 2022. And so again, the uptick that we saw in affordability last month was far better explained by a temporary drop in mortgage rates, more so than the homes themselves actually being worth less than this time last year. So we have low demand and low supply, and no clear way out of this power struggle. Where does that leave us exactly as we head into the new year? Well, as we proceed merrily along in 2024, whether the market goes up or down or remain trending relatively sideways will once again come down to affordability and thus interest rates. Will we see a significant and sustained drop in interest rates to perhaps below 6% before or after the summer selling season begins? And with 2024 being an election year, is it likely that the White House will step in and attempt to stimulate the housing market via new tax breaks or specialty programs for homebuyers? And what about the Fed? Will they make good on loosening their monetary policy as a means of re-stimulating the housing market? As of the recording of this video, rates are still bouncing around the high 6% range. And if it plays out that rates stay there for most of 2024, then I would say that I agree with the recent take of Doug Duncan, chief economist at Fannie Mae, who recently predicted that national home sales will be around 4% higher in 2024 than in 2023. Now that sounds like progress, and I guess it is, but a 4% increase from the lowest level of home sales that we've seen in 30 years is not necessarily what the market was hoping for. In a world of higher rates for longer, it seems like the only path forward is through consistent wage growth and very modest home price appreciation for the next several years as wages come up to match the incredible property appreciation we saw earlier in the decade. And the flip side of this would occur if we see rates start to decline into the second and third quarters of the year. And for the first time in a few years, this actually seems like somewhat likely to happen. Due to a meaningful change in Fed policy, as inflation is decelerating and overall GDP is trending downwards, we could see the Fed become more accommodating as they shift their attention away from battling inflation and towards keeping the economy out of recession due to growing unemployment. Now, with an untold thousands of buyers on the sidelines, ready to buy or sell a home due to household formation, but recently finding themselves unable to due to affordability concerns, it is possible that if rates start to trend down to or even below 6%, that the increased supply and demand that would come from that could fight against the traditional seasonal declines that we see later in the summer months, and lead to more transactions into the third and fourth quarters than we saw in the earlier part of the year, similar to what happened to our market back in 2020 and 2021. And so that's all the data I had prepared for you this time. Not the most exciting market update that we have seen over the last few years, but I still hope that all that information was of value to you to help piece together exactly what our market is doing right now. If so, feel free to hit that like button and let YouTube know that it was worthwhile. And make sure you stay tuned for future real estate news to help stay updated as to whether or not a movement into or out of the real estate industry is a good fit for you. I wish you all a productive start to the new year. We'll see you soon on the next video. Take care.